Well, greetings and welcome to our Outlook 2021 video. As we developed this report this year, we decided to entitle it Reflections and a Way Forward. We have a lot to think about looking back and a lot of work that we've done and will continue to do as we look forward. Now, let me frame out the report a little bit. And this video is really intended to give you a brief overview, so I really encourage you to get the report and take a look at it. In terms of what we're going to cover in the report, we're going to look back at 2020, do a year in review. We'll cover a little bit, obviously, the elections and really the implications as we move into the new year. We want to focus a bit on coronavirus, especially as it relates to its impact on our major investment themes. And related to that to a degree is the geopolitical landscape. We have our geopolitical dashboard, so we'll provide a bit of an update to that and how we're navigating things as we see it, given all that's going on. We want to touch on a couple things that are sort of important in our view. One is sort of understanding how to handle uncertainty and the unknowns, maybe some learnings from behavioral finance, and also some important tenets as it relates to developing an investment strategy. But of course, the anchor of this report is our 2021 outlook and how that then in turn is influencing the way we're guiding clients to invest in terms of asset allocation. Before we get started, though, I'll mention one other thing. We'll have a live event on January 14th at 4 p.m., a client webinar, and certainly encourage you, if you're viewing this video, to reach out to your Stifel financial advisor. You can get an invitation to that, and we'll sort of cover things live. I'll have a few colleagues in tow as we do that. Anyway, let's jump in with first a look back at 2020. You know, as we headed into the year a year ago now, things seemed a little bit stressed, but in hindsight, pretty benign, right? We were focused mostly on U.S.-China trade and the implications of trade policy. We were focused on Brexit that had just been approved, but then there was the idea that they needed to develop a trade agreement. We were focused on Fed policy and whether they were setting the dial correctly to kind of tune the economy, if you will. And then it's sort of out of nowhere, really for us here in the U.S., in February came the pandemic. And it obviously came with a lot of unknowns. We knew kind of going in as it started to unfold that it was going to lead to some shutdowns of businesses and, if you will, a shutdown of the economy. And the market reacted historically and quickly. We had a bear market, a very strong bear market in February and March. And we saw policymakers, both the Fed and then Congress and the administration, really focusing on developing what has been historic support, both fiscal and monetary support, to kind of help with the recovery. And the good news, of course, is that we've seen recovery. The market's made their way back. The economy is recovering well. We're seeing employment slowly improve. And then, of course, we got towards the end of the year and we had the election. And we're going to discuss that in detail in just a second. But the good news, of course, for the end of 2020 is, number one, for those invested in equities, markets ended up being up for the year. S&P was up over 18% for 2020. NASDAQ, as really a reflection of big tech stocks, was up 45%. So it ended up being a very strong year. Of course, a lot of that tailwind relates to that historic support that we talked about. But we also ended the year with a couple of approved vaccines to fight the virus. So we, obviously saw some vaccinations here in December 2020. But as we move into 2021, and again, we'll talk about this a little bit, there's basically a keen focus on getting as much of the population vaccinated as we can, as quickly as we can. All right, so the 2020 election, so the investment implications for 2021. We actually had our colleague, Brian Gardner, a guest author of this article. He's from our Stifel research group. And let me just summarize some of the key points that he made. I kind of think of it this way. We've had a federal government for a while that is a little bit locked up, right? There's sort of what's called gridlock, with a mixture of the parties having control of this area or that. And in some ways, what Brian's signaling, and we'll get to the Senate in a second, but that his gridlock is going to continue. Here as we see the transition from a Trump administration to a Biden administration. And again, we'll get to that in a second. As it relates to the Biden administration, it's sort of historical practice to think of the first 100 days. What are the things that an administration is going to do early on as they enter office to make a difference? And Brian's view is that the Biden administration will be focused mostly on basically the coronavirus and trying to help get that under control. So clearly some federal guidance and support as it relates to distributing vaccines, but probably a drumbeat for more fiscal policy relief Now, Brian indicates that, hey, we just had another big package in December, so it'll probably take some time before another package is ultimately put through the system and approved. In any event, when we think about what's going on with the government, it was sort of a result of the election that everything is kind of balanced. So Democrats lost some seats in the House. Biden won barely in terms of the presidential election. And then right now, as we record this video, it's actually the day of the runoff elections in Georgia. And so we'll find out in the next few days where control sits in the Senate. If Democrats take both of those runoff seats, then it'll be 50-50. With then Vice President Kamala Harris as the president of the Senate being able to split ties. But I think Brian's observation is, especially with the balance we're seeing, the idea of sort of an aggressive legislative agenda is probably not going to happen, at least relatively soon. So he thinks of it as Biden having kind of a center-left agenda, including an economic agenda. Now, there will be some focus on infrastructure, and if the parties can agree on certain things, maybe that'll be something that will be in focus. Another thing will be sort of green energy. So, for example, Biden likely returning the U.S. to the Paris Climate Agreement. And then finally, I'd say as it relates to things that influence the market, Fed Chair Jerome Powell has a term that runs through the early 22, I want to say. And so Biden will then potentially either ask him to stay on or appoint a new chair. And then as it relates to sort of the time it takes to fill other seats in the Fed, it's going to take some time. So I think the spirit out of Brian's article is some balance in the government and things being kind of slow moving with a focus on coronavirus and getting the vaccine distributed. Now, as it relates to coronavirus, another article that we developed this year was to review what I think of as our major investment themes, some that existed before coronavirus appeared, and one or two that have sort of either been evolved or appeared as a result of the pandemic. So let's start with one that was really an anchor for our 2020 outlook, and that was productive competition. So what we were basically saying is the world was getting more competitive. At the center of that was U.S.-China competition. And we talked about it from the perspective of, parties really fighting to compete, but that being productive in the sense that it would lead to innovation. What we didn't know, of course, when we developed that was that this virus was going to appear. And in some ways, we all kind of united to compete against this virus. And so, interestingly, we got into, obviously, some pretty significant innovation as it relates to, techniques to use to fight the virus. For example, one of our themes then is the fourth industrial revolution. This is the idea that sort of technology advances are accelerating the world between sort of technology and sort of software and the physical world. All those lines are kind of blurring. So take, for example, coronavirus. It just took a few days, I think a week, to map the coronavirus DNA, which is super important to kind of getting things going to fight the virus, both from a therapeutic and a vaccine perspective. Then we had a new technique called messenger RNA for the first two approved vaccines. And so that was an important advance. And then we've seen other advances we've all experienced in terms of remote working tools for that, and then really an acceleration of the use of robotics to try to lessen and minimize sort of human interaction, but keep manufacturing and business going. Now, another interesting one is shifting demographics. So the spirit of this is to say, let's watch the population in different sort of areas, if you will, of the population, and try to understand how that might influence businesses and the economy. And just in general, unrelated in some ways to the pandemic for the moment, essentially things have been shifting so that we're going to see sort of smaller growth, especially as it relates to the working population. So think of it as people either unfortunately passing away or retiring, that's going to start to happen faster in relation to people coming into the workforce. And so one of the metrics that everybody watches is sort of that growth in the workforce is a contributor to economic growth. The other thing we kind of lightly think about is, as it relates to reproduction, what happened during the pandemic and will there be implications, kind of a couple decades from now as it relates to a shift in population, either lower or higher, depending on how people were behaving during this pandemic. Now, another theme that we've been focused on for a while is geopolitical in nature, and it's protectionism. The idea that countries have been essentially self-focused, like how can we take care of our local citizens? And I think it makes sense to understand that that has become sort of magnified as a result of the pandemic. Things as simple as limiting travel. But I think more importantly, as it relates to business, people taking a fresh look at supply chains. So that's the idea of sort of getting components of your business, services for your business from all around the world. And those having been disrupted by the pandemic, companies just naturally have been looking to say, how can we become more self-dependent? So think of it as on the margin, a lot of things being onshored as it relates to supply chain. And then a new theme that we've sort of developed is the idea of managing through economic recovery. So what industries will come back? When will they come back? How does it relate to the vaccine? The sort of the journey to herd immunity, and that's going to influence certainly our work as we head into 2021 here. Now, I've mentioned geopolitics, and I'll just reiterate that we have a dashboard that identifies a bunch of risks that we've been monitoring for a number of years now, but I want to kind of look through a fresh lens given all that's going on, especially with the pandemic. So one thing that is there for sure is the coronavirus itself, right? And that's something that is here and it's impacting things, so we're monitoring it through this dashboard and in other places as well. We had identified U.S.-China competition. It's definitely here to stay. China is on a mission to become more and more and more dominant from a global economic perspective. And the sort of the push and pull that's occurred as it relates to the trade agreements and sort of policies being negotiated between the current administration and China, that's still there, and we expect Biden to continue to take a tough stance as it relates to that. But also as it relates to even the pandemic and how we're dealing with it. A lot of people have a tendency to look through the lens of how are we doing versus other countries, including China. Now, another thing that was interesting is I'd say going into the pandemic, Europe was sort of at risk of being more fragmented. So think of it, and obviously Brexit's an ultimate example of that, where the UK broke away, but just marginally that countries were sort of wanting to be, again, more identifying with themselves as an individual country as opposed to being part of the EU. And by our analysis, the pandemic has really flipped that a little bit and sort of softened that movement, because really at the end of the day, these countries, from a fiscal perspective, policy perspective, coordination perspective, have had to work together to fight the pandemic. So that fragmentation risk is sort of lessened a little bit as a result of the pandemic. Now, in terms of other things in focus, we've got U.S.-Russia relations and related tensions. And we would expect Biden to stay focused on that. I think by his history and experience, he's not a huge fan of Russia, so we expect those tensions to remain. We expect to see the relations between the U.S. and Europe to improve a little bit. Basically, Trump had an approach of trying to implement bilateral agreements, I think separate other parties and just work on countries one-on-one. I think Biden is going to take a more traditional multilateral approach, which will probably help with the U.S.-Europe relations. And then, one thing that's coming off the list after a number of years now is Brexit. So as we mentioned, they approved it a year ago. They've just approved their trade agreement. And so again, we'll keep it in focus, but we're sort of tagging it as resolved. Now, before we get into our outlook, I want to just touch on two topics that we think are important to consider. These are sort of present in the report. The first is to understand kind of how you deal with uncertainty and worries, if you will, about the economy and the environment and the markets, and how behavioral finance can help with that. So we've kind of, in the report, just outlined 3 steps. So the first step would be to become familiar with some of the common sort of human biases. One is loss aversion. We don't like losses more than we like gains. The second is herd mentality. If everybody's investing, maybe we should too. And then the third is recency bias, believing that whatever's happening in the moment, this can happen as it relates to a view on the markets, the economy, or an individual investment, that whatever's happening in the moment is likely to continue, when in fact those things tend to rotate, and oftentimes if they're down, rebound. Anyway, the second step is to really self-reflect. So we have a questionnaire and a model we call the Stifel Financial ID. It's super quick to take. And what it does is sort of map the test taker, if you will, across a number of dimensions to help a person understand how they might deal with uncertainty and some of the stresses in the markets as it relates to behavioral finance. And then the whole idea then is then with that third step is to take the learnings of those two things. Hey, what do I know about common biases? What do I know about myself? And essentially take a look at your investment strategy, work with your financial advisor to refine it, to tune it better to your preferences and what you've learned about yourself. Now, the second thing is, as I mentioned, is tenets of an investment strategy. So really, we see four key tenets in developing investment strategy. One is to define your goals and objectives. At the end of the day, a pool of capital exists to help you meet certain goals and objectives, and being clear and thinking through what those goals and objectives might be. It could be retirement, could be putting children or grandchildren through college, could be saving for a trip, anything. You kind of want to know, hey, what are my goals and objectives? And when ultimately am I going to use this capital? And all of those things will sort of influence the shape of the strategy. The second is a kind of a long-standing point of guidance, which is to be diversified. You'll hear the term asset allocation. So that's the idea of being diversified across asset classes, by stocks, by bonds, maybe by U.S. stocks and non-U.S. stocks, things like that. But then also I'd say be mindful to be diversified within asset classes. So if you're buying stocks and you just buy the hot 5 stocks that are kind of screaming positive right now, as I mentioned, a lot of times those things rotate, but you have that concentration risk and the possibility of rotation. So our guidance for sure is to be diversified as well within asset classes. Now, the third thing is to what we frame as align implementation. So our industry is full of products and solutions available for our clients. And, I think it's a very wide sort of breadth of products and solutions because a lot of people have different views and different wants and needs. That said, it's going to be a subset of products and solutions that make sense for you to invest in. And so think of it as both those learnings from a behavioral finance perspective, as well as some of these tenets of an investment strategy, align the product selection that you go through with your financial advisor to those considerations. And then finally, from time to time, whether it's annual, every 2 years, maybe for some it's every 6 months, review how things are going and refine your strategy. Our guidance is to think long-term, invest long-term, don't overreact to near-term performance, but once in a while, again, every year or two, it's worth taking a look and saying, gee, is my portfolio still, and is my investment strategy still invested in line with my goals and objectives? So those 4 tenets. All right, so let's get into our outlook, and I want to frame this really in 2 sections. One is to talk about scenarios, and then the second is to get into some specific views looking forward. So as those that have read our work understand, we recognize that we'll have a view, what we call our base case view, and we go in knowing we may be right, but we may be wrong. So the way we deal with that in terms of how we structure our work is to come up with 3 scenarios. So let's start with the base case, which we attribute, again, sort of in an informal way, a 70% chance of happening. So better than 50%, let's say 70%. Our base case is positive. The spirit around what we think is that we think the vaccination campaigns will hit little pockets here and there will be stresses and they'll be reported on. But at the end of the day, everybody's coming together to help these campaigns in terms of vaccinating the population be successful. And we think that'll unfold in the first half of the year and we'll make our way well along towards herd immunity. The second sort of component of our base case is that the federal government will continue support. The Fed will stay where it is, very supportive. As it relates to fiscal policy and support, the Congress and the administration will work together when they think then it's needed. Laws will get passed. We'll see more fiscal support. We think President-elect Biden will prioritize economic recovery. So don't do too many things, let's say massive tax increases, for example, while we're waiting for the economy to recover. And then we also think these general uncertainties geopolitically, that things will sort of calm down a little bit. So think of it as we make our way to herd immunity and we start to learn that that's happening, people are going to get incrementally more confident about the future. So then we have 2 other sort of scenarios. A bull case, which we attribute a 15% probability to, And that is simply the idea that people get more confident more quickly. So maybe it's driven by a faster timeline to herd immunity, that maybe we get into this rhythm with vaccinations and they kick up production, and all of a sudden we're sitting here at whatever it might be, March or April, and things are going super well. And it still will take time to get to herd immunity, but what will happen is both businesses and consumers will start to have more confidence in that future, and that will trigger spending, sort of business spending or consumption, and that will help businesses and help the economy. Then in turn, our negative scenario is the bear case. Again, we're attributing a 15% chance of this. And think of this as, a continued sort of surging of COVID-19 cases, maybe real disruptions in the vaccine efforts, and that ultimately more and more shutdowns occur, and there are headwinds there where people can't get a feeling that we're going to get out of it. In some ways, it's this idea of animal spirits, that just on average optimism of market participants maybe being impacted and lessened. That could lead to a slowdown in the economy and a turn down in the markets. So again, base case 70%, bull case 15%, bear case 15%. Now, as it relates to some specific views looking into 2021, let's just walk through a few. Number one, we think inflation is going to come up, and probably for the year average where the Fed's target is of around 2%. Now, it may be low in the first part of the year and a little above 2% in the second half of the year, but think of it as averaging the year around 2%. We think real GDP, as a result of all this support, will be well above trend for 2021. We think in terms of volatility in the markets, that we won't see the volatility that we saw in 2020, but it'll still be a little bit above normal levels. And then given the dynamic of the markets and what had been a pretty strong dollar last year, we see the dollar potentially continuing to weaken modestly. Now, I always think of equities as sort of a block, right? We want to make a judgment about equities here in the US and outside the US. And yeah, there are some nuances, large versus small, developed versus emerging. But the overarching kind of view as it relates to this outlook, because that base case is positive, is that equity returns will continue and be strong in 2021. So above our long-term expected averages, we think. We think small cap will outperform large, and we think emerging markets will outperform developed. And again, I think this is all sort of riding on the tailwinds of all the support that was put in place in 2020, coupled with probably a positive surprise incrementally that the vaccine sort of journey will go better than some expect. I mentioned the Fed. We think Fed funds rate is going to stay where it is. They're not going to act on that until probably 22 or 23 at the earliest. The 10-year yield, because of that inflation move up, will move up a little bit in our view. And then spreads, both investment grade and high yield, we think are going to stay kind of where they are. They're a little bit sort of what it's called tight, narrow. They may widen just a little bit because they've been super narrow, but not a lot. And we'll get into it, but we think an investment there makes sense. Well, let's turn to that. So remember that as it relates to the way we think about investing, we think being diversified within and across asset classes is really important. So we think exposure to many, if not all of these different categories on this page makes sense. But we have some clients and advisors that ask our views in the sort of medium term. So if we have a long-term view to be diversified, in the medium term, where might we lean into or out of markets? So here are a few takeaways as it relates to the equity complex. First, U.S. equity versus non-U.S. So if you remember those forecasted returns, we thought that the non-U.S. markets were going to rebound a little bit more. As a result, we're modestly overweight non-U.S. equity. And then when we zoom in, so even though we're underweight U.S. equity, within that category, we're underweight large cap, we're overweight small cap. Remember, we said we thought small cap was going to do a little better. And a category that's really underperformed, large cap value, we think is going to recover on a relative basis. So we're overweight large cap value. Now, outside the U.S., think of it as proportionately we're overweight both developed and emerging markets. So within the overall category of non-U.S., we're quote unquote neutral, but that's because we're taking the entire category up. So we'll get the benefit of that incremental return if those forecasts are correct. Now, on the fixed income side, I would just say that we're overweight in a couple categories that are worth noting. One is with the idea that inflation is going to go up a little bit. We're modestly overweight inflation protection securities. And then selectively, we're guiding people to be overweight high yield. And when I say selectively, it really comes down to the idea that if you're going to build a position in high yield, especially an overweight position, we recommend considering active management. It's usually in the form of a mutual fund, but the idea is that's a market that's highly inefficient. It's a volatile area right now in terms of risk and whatnot, but there's really a lot of areas for opportunity to make incremental return. And so, we have a team, as you probably know, that evaluates these kinds of funds, and we have our selections, those that we think are going to do well. So for a high yield, I would say active management. So listen, that concludes our presentation today. I first want to thank you for taking the time to listen. I'll remind you to consider our client webinar for a live discussion about this on Thursday, January 14th at 4 o'clock Eastern. And then finally, as I often do, I want to just report highlights, and the digital copy has links to all of our work. So it's always an open invitation to view our work. We publish daily, weekly, monthly, quarterly, annually, and super happy to do it. And so again, thanks so much for joining today. And hopefully we'll be speaking to you at that client webinar. Thanks so much.